Hello, and welcome to our podcast series, Got 5 Minutes, where we explore something new in the fintech space in less than 5 minutes of your time. Today, we have a special two-part episode for you featuring Greg Krasnov, founder and CEO of Tonik Digital Bank. So let's get on with part 1. Got 5 minutes? Great. Let's talk about Neobanks. This is Azmeen Ansar, Marketing Manager at Credolab. And as I mentioned earlier, today I have with me Greg Krasnov, Founder and CEO of Tonik. Hi, Greg. Thank you for joining us today.
Thank you for having me.
Great. So let's get on with it. In my first question to you is, in one of the previous interviews, you had mentioned that one of the things that excited you the most about venturing into Asia was that it was similar to what you saw in emerging Europe, but a few years behind. Now that you have already entered the region and have been in the region for about 5 to 6 years, how similar or different would you say the journey was in Asia as compared to emerging Europe?
I would say that the journey of the middle class evolution and that driving unsecured consumer finance is definitely very, very similar to what we experienced in emerging Europe in the last couple of decades, and same for Latin America. Latin America is also, most of it is quite a bit ahead compared to where Southeast Asian big countries are. But what I haven't accounted for is just how slow the banking sector in Southeast Asia is to adapt to these changes. So what we're seeing is, I was kind of hoping this would happen, but it is happening. The fintech companies are really eating the lunch of the banks on this particular market. And in particular, Credolab is in a great position with the alternative scoring platform to support this growth. So I think, to sum it up, the overall trend has been similar, but very different split between fintech and traditional.
All right. So when you look at your conversations in other interviews and also your businesses that you have catered to, they cater very strongly to the unsecured loans. Is there a particular reason that you're drawn to that?
Yes, because if you compare the different segments of consumer lending in the emerging economies, things like mortgage or car loans, these are longer term loans with larger ticket that require the lender to have accumulated longer term resource on the liability side. And in early stage emerging markets, that function in the economy still has not been created, because in the more developed economies, this function is normally fulfilled by players like pension funds and insurance companies that aggregate long-term resource, 5-year, 10-year resource. In most emerging markets, the interest rate curve basically disappears after 2 years. So you just don't have access to long-term resource. And therefore, the amount of lending that the banks can do into this longer-term assets is extremely limited, because you can't run this major mismatch permanently, right? You can't finance 10-year paper with 1-year liability, or you're running a huge mismatch. So it's a trend across all of the emerging markets, and that's why unsecured consumer tends to go and grow much faster in the early stages of the market development than the other secured types of lending. And we'll observe that across many markets, and it's the same trend now happening across Southeast Asia.
Okay. Coming to what happened in 2020 and how the role fintech had to play, 2020 really rocked the foundations of not only banks, but across all industries. And as a founder and co-founder of a series of fintech companies, how would you say fintech has helped financial industry, especially, absorb much of the impact that the pandemic had to offer?
That's a great question. Yeah, I think, point one is that because fintech companies have been the ones most exposed to unsecured consumer lending, then they're the ones that actually absorb a lot of the losses on that segment. Unfortunately, the losses have been very, very high for the fintech companies because most of them have not tooled up for proper credit risk management. They have not built proper scorecards, proper credit analysis tools. And I've been raising this issue, as far back as 3 years. I had actually an article on LinkedIn asking, which fintech lenders are going to survive the coming downturn. So now we're seeing that not a lot of them are surviving, but the good news for the banking sector is they haven't been so much exposed to this asset class. On the other hand, there are now service providers such as Credolab or Flow both companies coming out of the Forum Venture Build that I started, that help the banks to deal with their credit scoring, and Flow helps the banks deal, for example, with the credit losses, with the non-performing loans. They use technology to bring the best of AI and analytics and data science to help the banks reduce their non-performing loans once they've occurred. So this is definitely a positive for the financial sector overall, that now there are fintech companies serving the credit and servicing part of the value chain to help the banks bear through the downturn.
All right. Now, to end our part one of the podcast episode, I know a simple Google will give me the answer to my next question, but I want the listeners to listen to your take on this. If you can give us the top 2 or 3 reasons why you think a purely digital bank like Tonic trumps over a traditional bank today.
Number one is the user experience. We are not a bank at heart; we're a consumer company, a digital consumer company at heart. So that means not just branding, which of course our branding is completely different from that of a bank. We're trying to be on the first name basis with the customer and really speak their language, which the banks have had a really hard time doing that. They're typically perceived as very like stuffy and inflexible. But also the whole user experience, which is streamlined to the customer preference and is deeply, deeply grounded in consumer research. This is another thing that the banks are typically really, really horrible at. There might be some very enthusiastic young folks in the bank's marketing department that want to do good things for the customers. But then when they bring their product ideas to a committee that includes risk, compliance, internal audit, and all sorts of other people whose job is to put brakes on the business, then those people take over. And so big banks have not been able to innovate in a way that makes their product and the digital channel appealing to the consumer. So that's the second thing, the user experience. And I think we've managed to achieve something in the app, and we've had a lot of comments from the clients in our beta that it's very, very different feel than the typical bank digital app. And a couple of people didn't like that because it took them a while to get used to it, but most people were like, yay, this is great. And the third thing I would say is pricing and fees. Is that a digital bank that's built from scratch without a physical infrastructure is operating with a completely different cost structure than a traditional bank. So if you look, for example, at the only digital bank in the world today whose financials are readily available, it's Tinkoff Bank in Russia. So Tinkoff is listed on the London Stock Exchange, so you can see their income statement and their balance sheet. Their return on equity last year was somewhere in the order of 50% plus. This is unheard of for a traditional bank. And so what that allows the bank to do, the digital bank to do, is pass on some of this cost savings to the consumer. So our strategy, for example, as we enter the market, is we expect to be able to offer significantly higher interest rates to the consumers than a traditional bank does in the Philippines. And the reason for that is because I don't have a branch infrastructure to feed. I don't have to take that margin. I can pass on that the benefit to the consumer. Same thing with loans, same thing with fees. So I'd say those three things: it's the branding, the user experience, and the price.
And with that, we've come to the end of part one. To explore more on Neobanks and Tonic with Greg Krasnov, don't forget to catch our next episode of Got 5 Minutes. Until then, take care and stay safe.